You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got Lyn Alden, the founder of Lyn Alden Investment Strategy. Lyn, thank you so much for being on the podcast. It's a pleasure to have you on.
Thanks for having me here.
So Lyn, you've done a lot of podcasts. Most people know who you are. I wanted to start by thinking about what's going on right now in terms of the macroeconomy, in terms of what the Fed is doing, inflation, all of that. So, first off, the big question right now seems to be on the odds or the probabilities of a recession. So, in your opinion, do you think a recession is likely? What are the odds of a recession? And, if you think they are, how deep and long would that last?
So there's a reasonable chance that we're already in a recession. I mean, most, official recessions announced by the NBER are announced in hindsight, right? And so once the data is like firmly in, you can go back and say, okay, this was officially a recession. We are looking at 2 consecutive quarters of negative GDP growth, which is a kind of a different technical measure of recession, but that's more for like a real-time assessment. Labor market is still reasonably strong, but is showing signs of weakening, right? So, wage growth is below the inflation level, and now if we have several months in a row of rising initial jobless claims week by week. And so I think we're either in a serious economic soft patch or an outright recession, depending on how you want to define that. And if we kind of just zoom out about the whole thing, for the prior 2 years, we did, we had the COVID, the lockdowns. We had a huge fiscal and monetary response. So large increase in broad money supply, not just base money, but broad money, actual, checks to people to spend. While we also have obviously real world constraints on how much, our logistics supply chains, how much energy we can bring to market, how much we can turn that energy into other types of refined products. So we have, a demand surge with supply constraints. We get price inflation. And now we have policymakers trying to fight that back by curtailing demand, which is inherently a very difficult path, because if you don't actually fix the supply side, you're really just kind of treading water, right? You're just kind of actually kicking the can down the road to solve the problem. And so I see us in a current temporary pausing or reduction in demand in the face of a supply problem.
Got it. And how far would you agree with the argument that, so if you look at, for example, core inflation, while it's sort of moderated over the last few months, it still remains elevated. And, a lot of the argument around that is if you take, for example, the personal consumption expenditures, you can see that the trend post-pandemic, especially with, the pent-up demand dynamic plus, the stimulus checks to people, etc. What you've seen is that the trend of personal consumption expenditures has been elevated compared to what it was prior to the pandemic. And people have argued that we are actually seeing an elevated level of demand, so it's not entirely a supply issue. So how far would you agree with that? And if you would disagree and say that it is primarily a supply problem, do you think what the Fed is doing right now is broadly a policy mistake, or the Fed broadly has just no power at all?
So to the extent that I think it's a demand problem, I do think that impacts the nominal side. I mean, if you send checks to people, they can buy more things until you have more money chasing fewer, the same goods or fewer goods, which is very different than the 2008 response, right? They didn't send checks to people or give them child care tax credits, which are basically another type of check, right? So we actually filled up people's, their checking and savings accounts rather than just bank reserves. So we do have a demand surge, but a lot of it was just, some of it was elevated demand. Some of it was shifted demand. So taking out of one category and you couldn't travel for like 2 years, and shifting that over to like say at-home durables, right? So making your home better. You had a rapid shift in demand. And right now, what we're seeing, if you look at, say, retail sales, you see a very big difference between nominal retail sales and real retail sales. So people are paying, on average, 9% more. For many types of categories, it's higher. It'd be low double digits more than a year ago. But they're not taking more home, right? So if you look at nominal dollar terms, demand for goods and services is up, but the actual amount that they're taking home is really not that high. And that's, I think, why you see literally record low consumer sentiment, according to, say, nationwide University of Michigan surveys, right? So people are in aggregate rather miserable. And I mean, they have like 6% wage growth versus 9% inflation officially. If you look at house prices, or if you look at rent prices, or if you look at, say, let's take high protein foods, right? I mean, they're up like 14% year over year, right? While wages are up 6%. And so, we're getting basically a surge in demand for nominal terms up against a supply constraint, but we're not really buying more things. And so it's really that blend of the demand side and the supply side, along with some degree of currency debasement itself. If you look at, say, oil and gasoline prices, so let's say oil, oil adds denominated in gold, right? If you were to measure how many barrels of oil can you buy with a gold coin, it's not like unusual right now, but oil is relatively high in dollar terms. And so it's about the capex cycle and things like that, but it's also about just more units and some degree of debasement.
Mm-hmm. And so, when it comes to what the Fed is doing right now, would you argue that looking at the broad issue with commodities and oil has been brought under investment to an extent, has been aggravated by what's going on with the Russia-Ukraine war, etc. So would you argue that when it comes to what we're looking at with Fed policy, the right path would in a way be lower rates rather than higher rates, simply because lower rates would help production and supply, or would you broadly the Fed is just powerless and in a way should admit that it is powerless in this sort of situation?
So if you look at Europe, I mean, their natural gas prices spiked in late 2021, which is before the war. Obviously, the war has added volatility and uncertainty to the whole mix, right? I mean, that's unmistakable. But it did not create the problem. It's an overlay onto a problem that was already there. And so, to some extent, commodity cycles, they roughly go in these 10 to 20-year cycles, right? There's periods of underinvestment because prices are low. There's oversupply. Nobody wants to put new money into it. Eventually, demand keeps ticking up and the existing supplies dwindle. And that starts to result in more scarcity, a big price spike, and that encourages more investment to eventually come into the space. And so those are somewhat unavoidable. And so when you combine one of those with fiscal stimulus, monetary debasement, that sort of thing, you get a pretty big rapid response in terms of prices and scarcity. As for the Fed, they have some levers here because, for example, they can try to harden the dollar versus foreign currencies. That can squeeze emerging markets that have a lot of dollar-dominated debt, which can then curtail their demand to some extent, as well as curtailing American demand. Basically, you're hardening everyone's liabilities, and liabilities exceed money supply, right? So, I mean, if everyone's debts are getting harder, and if you're seizing up the domestic housing market, you can curtail demand temporarily, pretty significantly. So I do think the Fed is having an impact. They're not quote unquote powerless, but I think they can't fix the underlying issue, which is supply side. And I think we can also bring in Ray Dalio's long-term debt cycle conception. I mean, we've had decades of falling interest rates all the way down to zero, or in some cases negative, rising debt to GDP. When you get over 300% public and private debt to GDP, there's really not a lot, and then interest rates are zero, so you can't just keep lowering your interest costs, your servicing costs. You're kind of out of road in terms of credit expansion. And so those debts become increasingly hard to service. And one route is to choose like the nominal default path. Like, we just kind of can't pay some of those debts back. but then you get that vicious feedback loop downward. So instead, what policymakers normally choose is negative real rates. And so it's kind of like a way of spreading out the losses. Everybody gets a haircut in real terms. So those bonds pay everything they owe in dollar terms, but a dollar buys you less. And so that's the environment that I think we're in now, which is debts are super high. We're going to have negative real rates for the majority of this decade. There could be brief periods where we manage to get a briefly positive real rates, but I think that most of the time will be negative real yields. And that the Fed has tools at their disposal, but in some sense, they're doing a policy mistake in response to a policy mistake, right? So they were probably too loose while money supply was exploding and people were pouring into like Dogecoin. And whereas now, and they were calling inflation transitory, saying that, this is like a temporary thing. Then they said, okay, this is a mistake. Now we have to fight it. But now that they're fighting it when you already have an economic contraction.
Yeah.
And so I do think it's essentially a policy mistake, but I think it's almost a preordained policy mistake, because if your official mandate is to maintain price stability and maximize long-term employment, if you have 9% inflation and 3.6% unemployment, you're pretty much forced to try to increase unemployment and decrease official inflation. Now, you can take it, a more cerebral approach might say, well, I mean, this is supply side inflation, this is XYZ, you shouldn't do this. But, as for their mandate, that's kind of what they have to do. And if you survey people, there were surveys that said, okay, what is your biggest problem? What do you think's wrong? How are things good or bad? The biggest answer was inflation's too high. And like the second and third biggest answers were rent prices are too high and gasoline prices are too high, which is another way of saying inflation's too high. And then very low down on the list was labor market weakness. So both politically and just following their mandates, they're kind of forced to, try to tighten temporarily, even if it's not intellectually the best thing to do. It's kind of a forced policy error.
Mm-hmm. And the point that you bring up when it comes to what are the consumers or what are the buyers thinking? So if you take, for example, as you mentioned, the Michigan universities, the consumer expectations and consumer expectation survey, you can look at, for example, buyer optimism for housing, and it's just fallen off a cliff. And so that's where it becomes very interesting, because as the Fed continues to raise rates, what would have to break for the Fed to become dovish again? Is it just primarily the labor market? Is it that, we'll have to see, say, one or two inflation prints lower so that, we're finally seeing inflation start to come down? What would actually have to change for the Fed to start cutting rates and for us to get, what is called the Fed pivot?
So I'm looking for one of three different outcomes. One would be outright recession and labor market weakness. So let's say unemployment goes from 3.6% to 4.1%, which is actually in line with their predictions. I mean, it's funny, they're actually predicting higher unemployment and then doing policy to try to have that happen. But if that starts to materialize, I mean, if you have outright recessionary quarters and you have employment over 4%, that's a pretty strong sign for them to pivot. The other two are more about financial market liquidity and stability. And so, for example, the Fed had to pause rate hikes in early 2019 after, the famous Powell pivot. And a lot of people saw that the S&P 500 fell 20% and assumed that's why they had to pivot. But really, it was because credit markets, junk bond markets, there was no junk bonds issued for like 6 weeks. The whole market froze. And that's a more immediate problem for the economy and the Fed than asset prices going up or down. And so the second thing I would say is credit markets freezing. Right now, they've been, spreads are rising. It's not a very healthy market, but it's not a broken market. So if that market outright breaks, I think, especially combined with the other problems, you could get a pause or pivot. And the third one would be treasury market illiquidity. So we partially saw that in late 2019. You had the repo rate break, but the repo rate, that was a lot of that was, hedge funds were borrowing repo to buy treasuries. So it was kind of close to the treasury market itself. And that's why the Fed ultimately had to buy more T-bills in response to that rather than just fixing the repo market. We also saw that more acutely in March 2020 when you had, the global economy shut down, dollar spikes, some foreigners have to sell treasuries to get dollars because they have a dollar shortage, treasury market becomes illiquid, Fed reliquefies treasury market. And so I think either treasury market breaking or credit market breaking or, a severe obvious recession and labor market weakness. Those would be three signs that would lead the Fed to pivot. I think that in normal market conditions, if we saw what we saw right now, which is yield curve inversion, pretty clear recessionary signs, you probably already have a Fed pause. You probably would have them not raising rates in this environment. But I think because inflation's so high, and I think because of prior policy errors and kind of say for example, James, Powell being mindful of his legacy, I think they're going to push it a little bit further than they might otherwise would until they run into a more obvious sign to stop.
Mm-hmm. Got it. And interestingly, when it comes to when it comes to what the Fed is saying, so the Fed seems to be hell bent on raising rates until they start to see some sort of inflation. They start to see inflation start to come down, and Powell has repeatedly said that he's willing to risk a recession. What I'm curious about is, so as you mentioned, one of the conditions that you mentioned was the treasury market illiquidity. So is that similar to a March 2020 type of event where we start to see treasuries get sold and stocks get sold, and then you start to see the dollar go up? Is that sort of the sort of rush for cash or the rush for dollars? So is that sort of the scenario you're thinking of, or does it not have to get that extreme?
So that'd be an extreme version. And of course, obviously, I mean, the whole global economy coming to a halt within weeks was a unusually extreme event, right? So I mean, anyone who watched, say, stock markets, I mean, it was almost like Wile E. Coyote falling off the cliff. It was like a straight line down. It was silly. And there's more liabilities, that basically claims for dollars, than there are dollars.
Mm-hmm.
And so if the music stops all at once, everybody, there's everyone who has dollar-denominated debt, that represents demand for dollars. They need dollars to service those debts, and if their cash flows dry up, that's a problem. And the international market as a whole owns, $40 or $50 trillion of U.S. assets, and they have 13 or 14 trillion in U.S. debts. And so if they start to run into cash flow problems, what some of the creditor nations can do, or entities within the creditor nations, is they can sell dollar-based assets to get dollars. Now, there are some countries like Turkey that can't do that because they have more debts than they have assets. But a lot of their lenders in Europe or Japan or China and places like that, they have more assets than debts, and so they can sell dollar-denominated assets to get dollars. And so in March 2020, you saw an extreme version of that, which is you had a huge spike in the dollar. The foreign sector started rapidly selling off the run treasuries. The Fed had to have an emergency meeting and talk about that and be like, okay, we'll buy those treasuries, we'll reliquefy that market. They did all sorts of swap lines and things like that to try to give foreign entities alternatives. Rather than sell dollars, they could basically borrow dollars. So all these liquidity provision tools. I think what we're seeing right now is kind of a slow motion version of that, which is the dollar's been going higher. It looks disorderly on the dollar index because you're comparing it to like the euro and the yen, but those are rather unique circumstances. The yen, Japan's doing yield curve control at 0.25%. So they're basically just shorting their own currency. And Europe has very acute energy crisis. Whereas if you look at the dollar versus the yuan, dollar versus Brazilian real, I mean, obviously dollar versus ruble is kind of its own scenario, but dollar versus Canadian dollar, for example, it does not look disorderly, right? So it's more about Europe, euro and yen weakness, as well as weakness in some periphery countries, and not really like super strong dollar versus like all EMs and all developed markets. And so we don't see disorderly dollar growth, but we do see a tightening of the dollar, a strengthening dollar, and then you are starting to see reductions or flat holdings of foreign treasuries. And we start to see the MOVE index, so treasury volatility is kind of at decade highs. Liquidity is not that great. We saw a decent auction in 20 years the other day, so it's not fully disorderly yet, but it's not the healthiest we've seen in a while. The one thing that I think is helping to hold the wheels on the cart is that there's also not a lot of treasury issuance. So we had very strong tax revenues in 2021, and going into the first quarter of this year, we already had a large treasury general account balance. And so there's not a lot of treasury issuance, net issuance in quarter two or quarter three. And so there's not exactly a lot of treasury demand out there, but there's not much treasury supply either. And so we don't see anything disorderly yet. I think that if they were to continue tightening, meaning raising rates and quantitative tightening and dollar going up, I think by 2023 you probably would get disorderly treasury markets. I think that basically there just wouldn't be a foreign bid for treasuries. You get falling U.S. tax revenue, and therefore the treasury would probably have to come back to market with more net issuance, and that would be troublesome in such an illiquid market. But I don't think we're there yet. But I think, and I don't think it's just the whole thing's playing out on a longer timeline than what we saw in 2020, March 2020. But I think it's a similar phenomenon that basically they can push this until they run into one of the three issues I mentioned. Basically, obvious recession and labor market weakness, credit market, absolute freezing, or treasury market, absolute freezing.
Got it. The other thing that I had in mind that you touched upon was real estate prices and homes. So if you look at, so it seems as if the housing market, at least from a demand standpoint, is very poor, and in many ways from a supply standpoint. So you can see housing starts are still near their highs, etc. And if you look at, for example, the home builder ETF, say XHB or ITB, you notice that they have they were pretty recently, they were about 50% down from their highs. So when it comes to thinking about real estate, what's your framework for navigating that? And if you look at, for example, Harris Kupperman, so he's highlighted sort of the structural issues within the housing market, and he's at least on a long-term basis more bullish on these home builders. So what do for example, so what are your thoughts on what's going on in the housing market?
I think I fall somewhere in the middle. The general consensus is now very bearish on housing. The idea is oversupply. Demand just totally froze up because the rise in mortgage rates just completely froze, and that's all real. Whereas I think Harris Kupperman would focus on the longer term, and I tend to agree with that view. I'm not as bearish on the broad U.S. housing market as I am on other things, at least in nominal terms. Certain zip codes certainly way overdone. You had certain, you had certain cities had major booms. You had local pockets where you had just euphoric bidding for housing. Bids would come in just super fast. You have more bids you know what to do with. You sell way above your initial price. I think that's behind us, and that's going to stay behind us. But I do think that when you look at nationwide average nominal housing prices, I don't really expect a big downturn. I mean, you could have a dip, you could have things like that, but I expect more of a stagnation. And so if that trends sideways in nominal terms, that'd be going down in real terms. If it trends mildly up in nominal terms, that'd be flat in real terms. And that's more the environment that I see. I think that the excess will come off, but that I think that it'll return to, okay, what pockets are underbuilt and what pockets are overbuilt. So it's very zip code dependent. I also think that due to what I said before, I mean, I think by the time we get to 2023 or so, I think the Fed will probably have paused. And I think we'll see probably a reduction in mortgage rates and potentially long duration treasuries. And so I think that that'll ease the market to some extent. The interesting thing is when this happens, right? So mortgage rates spiked, so obviously demand dried up, but also sellers dried up. Because if you have a home and you're thinking about moving, you really have to think twice about that now. Because if you sell your home and then you buy another home, you're going to have trouble getting financing on that at any sort of reasonable rate. Basically, you're either going to get the same home for like the same type of, the same price of home for a higher monthly cost, or you're going to have to settle for a less expensive home for the same monthly cost. So even sellers have less of an incentive to sell in this type of market. So I think that it's more about the market being frozen than anything else. And so I kind of have a neutral, choppy, sideways view on the market and kind of a very zip code dependent view.
Got it. And let's go outside the US. So for example, I'm based in Canada. So Canada's got one of the frothiest real estate markets. And so if you look at China, for example, look at Chinese real estate market, at least in nominal terms, seems to be the largest market in the world. So do you have any views on real estate outside the United States?
Generally bearish. So different markets have different nuances. So in the United States, we pour our capital into stocks rather than real estate for the most part. And then the foreign market, they pile their capital into US stocks. Kind of our capital markets are like the crown jewel of what we optimize for. Whereas a lot of the global markets is the opposite. They don't invest heavily in their stocks, but they invest heavily in their real estate. And so when they have asset bubble, it's more like in the real estate market. And China's really been, I think, at the core of this because Chinese consumers heavily prefer real estate investments over stocks. They also like things like gold, physical metals, but really the bulk of it is real estate. And because real estate prices are so high, as well as because many of them want jurisdictional diversification to the extent that they can get it, they want to go outside their country. So they buy real estate in Australia, they buy real estate in Southeast Asia, they buy real estate in Europe, they buy real estate in Canada, especially Australia and Canada. They really influence those markets because they're not really huge markets when you think about it compared to China. And so that combination of the domestic cultures investing heavily in real estate and then foreign buyers coming in and bidding up real estate, I view those markets as rather overvalued. In a similar way that going into this year, I viewed U.S. equities as overvalued. Whenever foreign capital is heavily pushed into one area, I get quite concerned when you combine that with high valuations. So I've been concerned about U.S. equity valuations, and I've been concerned about Canadian, Australian, Chinese real estate valuations. So, I would take U.S. real estate over many other countries' real estate. But at the same time, I would seriously consider, say, value stocks outside of the U.S. compared to some of the, say the S&P 500 that we see in the U.S. Things that are under-owned, but that are still chugging along and doing pretty well.
Yep, I see. And moving on, I wanted to talk about when you look at stocks. So stocks have sold off. Stocks have sold off quite noticeably. We've seen a very big move lower in treasuries as well. So when it comes to your ideas around the Fed pivot, and the three factors that you need for the Fed pivot, as well as your thoughts on how we're likely in an economic soft patch or maybe in a full-on recession. When does it finally become time to start purchasing long end treasuries? So would you start right now, or would you still, or are you still holding off till the Fed properly pivots?
So I started a month ago, which is actually pretty unusual for me. I've been known as a bond bear, more of an inflationist. I mean, I've been since I kind of hinted at it in 2019, and once we actually got the stimulus in 2020, I've been firmly in the inflationary camp. And not really just transitory, kind of multi-year inflationary camp. And so I've been obviously avoiding long duration treasuries, sticking to, real assets, and to the extent that I hold defensive assets, it'd be like gold and cash. But, when you have a record bond sell-off, I mean, the first half of this year was absolutely disastrous for mid to long duration bonds. And you start to get treasuries at 3%. I started to take a somewhat contrarian interest in bonds, which again is coming from a structural bond bear. And it doesn't mean I want to hold them for 10 years, but it means on a 6 to 12 month basis, I view that the risk reward of owning intermediate term and semi long term bonds was attractive. I can't really bring myself to buy 20 or 30-year bonds, but the kind of the 5 to 10-year range became quite attractive to me on a risk adjusted return basis. And I still think that's probably true. I mean, we have yield curve inversion, we have clear economic weakening, and so even though the whole yield curve is submerged below the prevailing inflation rate, I think that there, for a defensive part of a portfolio, that's now a useful hedge against disinflation. And so I'm no longer, at least in the near term, opposed to bonds in the same way that I was. I think there's still risk to the view. The fact that the Fed's trying to sell bonds, or let them roll off. The fact that we don't see a lot of foreign demand outside of kind of individual auctions, and just treasury market illiquidity in general. But I do think this is probably going to improve at some point, especially with some sort of Fed pivot.
Got it. And so when it comes to looking at stocks, so would you wait for a proper shift in liquidity, Fed policy, etc. So go through a proper recession, and then towards the end of the recession, obviously Fed starts to ease, cutting interest rates, probably doing another round of QE. So would you wait for liquidity conditions to change completely, or are there any other factors that would make you bullish in stocks?
So I think that it depends on the way that an investor or a trader manages their book. But for example, I generally manage it on a dial rather than like a on and off switch. And so, for example, going into this year, I often wrote that with the Fed trying to do QT and raising rates and PMIs rolling over, I was somewhat defensive. I was like, okay, I like energy, I like healthcare stocks, low volatility stocks, I like some certain consumer staples, things like that. Now that we've seen, kind of a small bloodbath in equities. I mean, there are blue chip bank stocks that are down 30, 35%. There are dividend aristocrats. I mean, if you look at Stanley Black & Decker, right? It's this company has raised dividends every single year since Lyndon B. Johnson was president. That just had a 50% drawdown in its stock price from historically high valuation levels to moderately cheap levels by its average history. And so I do think that with the carnage that we've seen, at least in some pockets of the equity market, that it is more interesting than it was 6 months ago. And so without trying any sort of call a bottom, I have been shifting a little bit of capital back into it. Again, because for me, it's kind of this dial. I mean, if you have euphoria, I pull back a little bit. If you have, pessimism, I kind of dial into it a little bit, lean into it a little bit. What we've seen already is the big multiples contraction. The big thing going forward is whether or not we're going to have big earnings contraction. And so that's the key risk, I think, going forward. I did a back test on a century of looking at inflationary spikes of this magnitude, high single digits, double-digit inflation, and what happens with corporate earnings. For the most part, you have weak earnings in real terms, but kind of choppy sideways earnings in nominal terms. I mean, when you have 9% inflation and you just had huge money supply growth, it's hard to really have like a big sharp drop in nominal earnings if you're a reasonably healthy company. But instead you have more of a malaise. I mean, your revenue's going up, but your expenses are going up, your margins are getting squeezed a little bit, and so you kind of chop along sideways, which is not great in real terms. And that's kind of how I'm modeling a base case here. That I don't really expect super bullish stock action. I think stocks, broad stock indices could be range bound. I think that earnings are going to broadly be disappointing, maybe not catastrophic, but disappointing. And the things of the high quality businesses that have already fallen 30 to 50%, that many of which pay dividends and things like that. I think you could certainly start leaning into those, as long as you have a long-term mindset and are prepared for the volatility that can come with the scenario where the Fed is still tightening policy into an economic deceleration.
I see. And so you're not wildly, but I mean, obviously there's no reason to be wildly bullish stocks. But then you mentioned energy stocks. Are you still bullish energy stocks at these levels when you look at where oil is, etc.? Or are you starting to dial back on some of those positions as well?
So back in the middle of 2021 and late 2020, when I was kind of pounding the table publicly on energy stocks, after the huge gap in performance and kind of brief euphoria, I got a little bit more hesitant on them, while still emphasizing that I'm bullish with, say, a 3 to 5 year view. I'm still structurally bullish on energy. I think it's underowned. We don't see a lot of euphoria in options around XLE or XOP. there's really not a lot of, say FinTwit got a little bit excited about energy stocks, but we don't really see large institutional pools of capital just pile into energy stocks. It's just not an over-owned thing. And so especially after this recent pullback, I'm still pretty bullish on the sector. I've also been emphasizing for people that might want a little bit less volatility. I think the energy pipelines are interesting. And so they were very bad performers from 2014 through 2020. They were over leveraged. They were kind of using Ponzi dynamics. They're always issuing debt and equity. And that whole industry kind of right-sized for like 6 years. I mean, you had kind of a 1-2 punch. The whole oil price crash and capital pull out of 2015 really hurt them. And then the ones that were still standing, a lot of them were punched down in 2020. But after the dust settled, I think that space is very attractive. I think it's broadly deleveraged. It's rather cheap. It's not highly tied to energy prices. It's more about energy volumes. And of course, the last thing we need right now is reduction in volumes. And so I'm pretty bullish on both energy producers, but with the acknowledgement that there's a lot of volatility there going forward for the next 6 to 12 months. And then also on the pipelines for people that might want, 6, 7, 8% dividend yields that are, I think, probably pretty sustainable if you pick some of the higher quality ones.
And you mentioned that you're still structurally bullish from a 4 to 5 year, as a 3 to 5 year, so more longer term view. So when it comes to what is called the ESG transition, a lot of people in FinTwit have highlighted the potential role of uranium and nuclear energy as fulfilling that gap in ESG, just because in a way uranium is just not dependent on, say, weather conditions, and it is extremely safe, and when it comes to energy efficiency, it is pretty energy efficient, etc. So but the problem with that trade is it has been very disappointing year to date. So if you take, for example, the URNM, the uranium, the uranium ETF ticker, that is rough. So that is roughly where it was. It is roughly where it was at the start of the year, roughly speaking. So what are your views on uranium, and broadly, what are your views on the ESG transition?
So a bunch of different questions there. I would say, I think that I'm broadly bullish on a number of commodities in general. That would include uranium and copper and things like that. But their timelines all differ. And so, for example, ESG electrification, I think 5-10 years from now, copper is probably much higher priced than it is now. But at the same time, I've been a lot less bullish on copper than I have on energy, because in a declining PMI environment, copper is more discretionary. If you look at, say, a copper to gold ratio, that generally follows the PMI, Purchasing Managers Index chart pretty closely. And so something I've been tracking since 2021 is that copper rolling over as priced in gold. And so I took profit on my copper miners, but not really my energy stocks, because I think that OPEX, on commodities with ongoing expenditure like oil and gas are more attractive to me in this environment than more discretionary types of cyclical investment like copper. But whenever we do see signs of a bottom in some of these, say things like copper, I'd be a long-term interested buyer after this cycle's over. I've just been more hesitant there. As for uranium, yeah, we're in one of those environments where, I mean, if you're flat year to date, you're not doing that bad, right? I mean, if you compare it to this, the S&P 500, if you compare it to foreign equities, if you compare it to bonds, long duration bonds, flat or mildly down year to date is not the end of the world. And so my general approach with uranium is I for the most part, I prefer uranium itself rather than uranium miners. I think you have a lot less risk there. Maybe you'll get obviously less explosive upside potential. But I think that if I'm comparing, what do I want to own for 5 years? Ironically, a chunk of uranium is probably more attractive than a chunk of dollars or a chunk of bonds, that are kind of programmed to devalue over that multi-year period. Whereas uranium, it's not so much that you need nuclear demand to increase; you just need it to not go down. I mean, if basically it's undersupplied as it is.
Yeah.
And so I think that when you look out 3 to 5 years, prices pretty much have to go up in order to incentivize more production. And so I think that as a slice in a portfolio that is rather uncorrelated with the other assets, I still like uranium. It'll certainly be disappointing in any sort of given 6-month period. That can easily happen. But considering what we saw in broad asset prices, I'm not too disappointed with what uranium has done so far.
Mm-hmm. Yep. Yep. And so you mentioned that excluding near-term economic problems, you're broadly bullish copper as well. So when it comes to these other commodities that you're bullish, so would you play them using miners or mining stocks, or would you play them directly just through futures?
So I think it depends on the type of investor you are. I think that futures are good, especially if you do long duration futures. I think that's pretty attractive here. Because I have a pretty big emphasis on equities, I tend to play the equities a lot as well. And one way to think about that is that even if say oil just chops along sideways for a few years, many oil companies are very profitable at current levels, and they're able to pay high dividends, they're able to buy back their shares, they're able to strengthen their balance sheet, and they're really not that expensive. And so, but obviously you're taking on jurisdictional risk. I mean, a lot of countries can, their governments can come out and say, hey, energy companies are doing great, let's give them windfall taxes. So you're taking on a somewhat different risk profile. So I think that both are ways to play it. I think when it comes to things like gold or uranium, that are easier to just kind of have a vehicle to own it long term, or something like gold you can really just physically own. I tend to prefer the risk-adjusted return potential of those compared to their miners. But when you get into copper and oil, I tend to like the producers just as much as I like the underlying.
Mm-hmm. Yep. Yeah. That makes sense. And the point that you made on even if oil doesn't move from these current levels, and you can still make a lot of money. That is very interesting. I wanted to move on to some of your work on what you call petrodollars. And so, do you have any views on the petrodollar economies of the Gulf? So within this energy cycle, with these higher energy prices, they've done very well. Um and what is important to note is that a lot of these economies are dominated by oil production and dominated by just hydrocarbon generation. And what do you think the end game for these Gulf petrostates is?
So that's a broad question. I think that we can divide it into two parts. One is the Eurodollar system itself, that during the Bretton Woods era, you had a proliferation of offshore dollars and demand for dollars and offshore credit creation. But then starting in the mid-70s, you also had a deliberate policy by U.S. officials to try to have oil producers sell their oil in dollars, and then just as importantly, take the dollars that they earned from that and hold treasuries. And so it's really kind of two systems overlaid on top of each other that are self-reinforcing as a network effect. And my base case going forward is that we're going to see some degree of diversification in that system. And Russia's kind of the flashpoint of that, where they're obviously more willing to sell their commodities in other currencies now. And obviously, less willing to hold their assets in treasuries. I mean, even before their foreign exchange reserves were frozen, they already mostly de-dollarized. And now it's obviously, completely. And so I think that we've been in from say the 1940s to the present, we've been in mostly a unipolar system. And I think we're shifting towards a more multipolar system where you have these different axes of power. You at least call it two. So you have kind of the Western powers, and you have kind of the Asian powers. And you could have three, right? I mean, you can have these different groups. And that's not a narrative that sells a lot, because most people either want to, they're either like rah rah US forever, or it's like dollar collapse, China takes to the world, whatever. So whereas I think the more realistic view is that United States has something like 4% of the global population. We, at our height, we reached over 2/3 of like foreign exchange reserves. I think that we've peaked in that sense, but that it's still it's the depth of liquidity in the dollar market is still huge. The network effects are still huge. The size of the economy is still huge. And that instead, I think we're going to see more diversification, especially among BRICS nations, so especially among large emerging markets, to basically engage in a number of different currencies. And with China being the world's biggest importer of oil now, I think they have considerable sway over oil producers. Russia being the most obvious example at the moment. They just announced. I mean, they have record volumes of natural gas going over their pipelines to China, while obviously they're curtailing some of their supplies over to Europe. I mean, we've just kind of seen a shift east there. It still remains to be seen what Middle Eastern countries are going to do. But I do think that China has increasing sway over some of them as the United States has pulled back militarily, and as we've just kind of changed our political situation. So my base case is towards more decentralization. We've already seen an interest in countries generally upticking their gold purchases over their treasury purchases because they have essentially a somewhat inflation protected, potentially self-custodial asset that can trade in multiple currencies. They can't be frozen if they hold it. And so I generally see diversification going forward. I think that system kind of reaches peak centralization. Now we're kind of going to spread out for a period of time.
Yeah, I think that's fair. So we start to see sort of a potential multipolar kind of world where you've sort of got the U.S. on one side, and then you've got, say, Russia and China and these other major powers on the other. Yep. And so when it comes to thinking about China, so broadly speaking, the consensus view, at least on, say, FinTwit, remains bearish China. And so the typical ideas that are highlighted are, one, their debt being unsustainable. So Michael Pettis' work on how China has overused its investment function and has not used the consumption function enough, and so you would have to see a rise in household consumption. And so his argument is broadly that the debt is eventually going to become a problem. The other issue is demographics, and the third issue is regulation. So how does China end, and what comes next in China?
So I generally see a shift towards production to consumption longer term there. I'm perhaps less bearish than FinTwit as a whole on China, at least in the multi-year sense. We in the near term, we're starting to see credit cycles pull up a little bit. I mean, they had a big reduction in credit impulse. Now we're seeing that turn up. I think probably the worst is behind China in terms of the CCP cracking down on big tech companies and some of the problems in real estate. Does that mean I would want to have exposure to Chinese real estate? Not really. It's overvalued. It's clearly there's bubblicious aspects to it, similar to Australia and Canada, and really that's the epicenter of it. But I think that when you look out long term, equity prices are reasonable, and the economy still probably has legs to go. If you look at what happened to Japan, I mean, they had obviously their demographics peak, and then they entered a long-term malaise. They didn't collapse; they just went sideways for a very long period of time. But with China, I would point out a couple differences. One is that it's a much bigger share of the economy than Japan was, and so it's more relevant. And number two, in the late 80s, Japan had an equity bubble that was bigger than the US .com bubble in terms of valuations. I mean, if you look at CAPE ratios, they had like a 90, CAPE ratio average. It was absolutely insane. And then they had simultaneously a real estate bubble that dwarfed the valuations of the US subprime bubble. And I mean, the classic example was that like their imperial palace was like the land was worth more than California. Right. I mean, that's obviously a silly extreme, but that's kind of the level of euphoria that it reached. I mean, actually, briefly, the Japanese stock market capitalization was slightly bigger than the American stock market capitalization in the late 80s, which is insane. And so that shows when you go sideways from that level, no wonder you went sideways. I mean, it's actually a blessing they went sideways and down for a while because it could have been far worse. With China, we see that the real estate bubble is obviously excessive, but equities are cheap. Nobody wants to own them. in general for good reason. I mean, after we saw what happened to Russia, I mean, basically, there's large pools of capital that have to seriously consider the possibility that they get zeroed out of their, Chinese equity holdings if something happens politically. And so overall, I view that it's less an extreme situation than we saw in terms of Japan. But that, there are some similarities. You have a demographics peak, you have a real estate bubble. And so I think that its engine of growth will, globally impacting will slow down, but that they still have, I'm less bearish overall. Now, there's still tail risks that I think that could make some of the most bearish scenarios, unfold. I mean, when you have that centralized of a system, you're obviously pretty fragile. And so if there are major missteps as it relates to commodity imports, inflation, civil unrest, things like that, you could see rather non-linear negative outcomes, but they'd be outside of my base case overall. So I'm less bearish than the bears are.
Yeah, that's fair. The last thing that I wanted to broadly discuss was the role of gold and Bitcoin in a portfolio. And so, if I remember correctly, you have some Bitcoin in your portfolio. So could you sort of describe, one, why you own it, and two, what is your broad view when it comes to crypto, and Bitcoin?
So both gold and Bitcoin represent outside money. I think as Zoltan Pozar would describe it, which is basically money that you can self-custody and that can move around the world, outside of traditional financial platforms, right? So outside of your brokerage, outside of these kind of walled gardens. And because gold's the established one, the larger one, I mean that generally holds up better than many risk assets in declining PMI environments. It might go up, it might go sideways, it might go down mildly, but it's generally going down less than what we see in a lot of risk assets in those kind of risk-off environments. Bitcoin tends to be the opposite. It's the younger asset, more explosive upside potential, but it generally follows the PMI cycles pretty closely. So it does very well in rising PMI environments with a sample size of 3 or 4 of them, and it generally does pretty poorly in declining PMI environments. An even stronger correlation is that Bitcoin follows global liquidity. So if you see global M2 as denominated in dollars, when that's going up, generally Bitcoin's going up, and when that's going down, generally Bitcoin's going down in rate of change terms. And that tends to be similar to the PMI cycle, but precedes it a little bit. So for that reason, you generally see Bitcoin bottom a little bit before you see PMI bottom. Basically, economic activity bottom. But of course, it's a little over a decade old asset. We don't have the longest track record with it. So the way I interpret Bitcoin is I view it as the most credibly decentralized cryptocurrency. So a lot of them are kind of, they market themselves as decentralized, but they're not really decentralized. Bitcoin, I think, has the most credible decentralization, combined with the fact that, compared to other proof of work cryptocurrencies, the depth of liquidity is very high. The network effects are very strong. I like what I see happening in the Lightning Network in terms of kind of a channel-based payment system built on top of the broadcast network. So it's kind of a network effect on top of a network effect. And so I'm pretty structurally bullish on Bitcoin as a slice in a portfolio. I mean, if you look at worldwide, if anyone follows the work of Steve Hanke, for example, I mean, he's always outlining how much inflation is happening in emerging markets around the world. I mean, where billions of people live, there are tons of countries that have 10, 20, 30, 40% inflation or higher. Many of them have repeated currency devaluations or even hyperinflations in their lifetime. And there's basically a global market, I think, for peer-to-peer money and inflation-resistant money. But of course, someone has to put up the volatility and the risk in such a rather new asset. And so I generally, in this environment, I generally prefer value and dividend and real estate type of stocks, more the value spectrum. But in terms of growth areas, Bitcoin is one of the ones that excites me more than many others. And it's kind of a whole different class because, again, just like gold, it's outside money. So someone can self custody it. They can bring it around the world. They can send it peer to peer, which I think is pretty relevant in a time where 50% of the world is classified to live under authoritarianism. Very large swaths of the world have double-digit, in some cases triple-digit inflation. And so I think it's a pretty powerful technology.
Yep. Yeah, and No, what is interesting is you made the point that Bitcoin is credibly decentralized. So I wanted to ask you, we see a lot of what are called whales within the crypto sphere, and specifically within Bitcoin, where you have a handful of people or a handful of institutions that own a great deal of Bitcoin. And in a way, what they're doing there is they're in many ways monopolizing, or at least oligopolizing, because there are many whales, but then there are a few people with a lot of Bitcoin. And so if in a sort of scenario where they had to sell, they would be single-handedly driving the price by themselves. So how credibly decentralized is Bitcoin when you consider the existence of whales who certainly have a significant impact on price?
So I think we can somewhat separate fundamentals from price. And so in terms of price action, I mean, I agree that there are these concentrated pockets. One thing I warned a lot about was the Luna fiasco. The second stage, that the whole 3 Hours Capital fiasco, is more opaque, but the Luna one was pretty much out in the public. And so I warned this whole scenario where they could be selling Bitcoin into a weak market, and kind of describe that in detail, and that's ended up happening. So there certainly are these whales that can influence price.
Yeah.
When I talk about decentralization, I'm talking mainly about the fundamentals. And so, for example, whales have no ability realistically to change Bitcoin's monetary policy or to push updates onto users. And so, for example, during the whole 2015 to 2017 period, there was something called the block size war, where a lot of powerful entities within the Bitcoin ecosystem wanted to change Bitcoin's code. They wanted to increase the block size to allow more transaction throughputs to go through, with the trade-off that it would be harder to run a full node, and therefore the network might be might be less decentralized. Basically, it'd be less easy for an individual user to run a full node. And so they tried to push these updates through. I mean, they had something like 80% of the mining hash rate. Coinbase and many other large companies in the space were in favor of the block size increase, and they were unable to push that through to the network. And that's because the large, highly distributed node network of individual users, there's no ability to push updates to them. And so if you try to fork Bitcoin, you end up just kind of going your own way. You're unable to kind of push change to the network. So when I talk about decentralization, I'm generally talking about the ability of centralized entities to change Bitcoin's code or change how it works in a meaningful way. I think a contrast to that would be, say, Ethereum, which is doing interesting things. But if we just specifically analyze the decentralization variable, for example, they've had difficulty bombs in their code for something like 7 years now since they launched, which means that that basically allows developers essentially to push updates onto users in a way that's not possible in the Bitcoin space. And so, whether you look at it to run a full node, the ability to code, things like that, you can measure how decentralized a project is. And so that's generally what I refer to when I talk about decentralization rather than price, which obviously leverage and whales and rise in liquidity conditions and fall conditions, you're going to get massive variations in what is still a very small market.
Yep. Yeah. With that, Lyn, thank you so much for being on the podcast. It was absolutely wonderful to have you on.
Oh, happy to. Always happy to be here.